good, bro? You good, bro? Might be better actually if it was that side. Smelly. Yeah, whatever. Why not just go with it? Right then, let's talk about my Moneybox lifetime ISA. Let's talk about the stock market, and let's talk about the coronavirus, which has got everybody in quite a panic. First things first, if you're watching this, I just want to say, be safe. Be as safe as you possibly can. Don't do anything risky. Don't take any risky travel. Try and keep yourself out of harm's way as best you can. We don't yet know how small or big a problem this thing is going to be worldwide or for individual communities. This coronavirus pandemic is concerning, to say the least. Do what you have to do, but please, let's all try and quell the spread of this virus. Anyway, the point of this video is to discuss briefly the Moneybox lifetime ISA, specifically my Moneybox lifetime ISA, and what the stock market has done to the value of it over the last week and a half. So if I look at my Moneybox lifetime ISA value at the moment, you can see at the top my contributions are £3,150.30. Current earnings are £690.31. £782.59 of that are from the government 25% bonus, and my investment gains are currently at minus £45.23 plus the fees at the bottom. So the current value of my lifetime ISA is £3,840.61. At the very bottom there, you can see that the current earning performance is 21.91%. A few weeks ago, that was as high as nearly 40%. My lifetime ISA and the stocks and shares that I was invested in was doing really well. It was flying high. I had nearly £4,000 in there. Obviously, with what's going on with the coronavirus, and I think maybe I have heard rumours of a little oil war going on between Russia and Saudi Arabia, the stock market has taken a big hit, and so the value of my lifetime ISA is down. It's not the best to see when you're saving for a house like I am, but the most important thing to remember is some advice that I've heard Dave Ramsey give. The stock market is like a roller coaster. The only people who get hurt are the ones that jump off. We don't yet know what's going to happen with the coronavirus, and obviously the stock market is quite volatile at the minute. But what we are hoping is that it will come back up once the pandemic has been assessed correctly, dealt with, and then society can go back to its normal functions. So again, please don't take this as financial advice. I'm not a financial advisor. I'm only going to do what I'm going to do, and then I'm going to tell you guys so that you can make your own opinions based on multiple sources of information that you've got from wherever you get it. Now is not the time to start selling stocks and shares, in my opinion. What you want to do is just wait, hold on. It is like a roller coaster, and hopefully it will come back up soon. Don't go panic selling, because once you panic sell, then you really have lost all of the money that you think you've lost with the stock market being down. It's very, very likely that it will come back up. And in a second, I'm going to read the Moneybox little advice screens that they put up to explain what's going on with the stock market at the moment. But yeah, personally, my lifetime ISA is down. It's not nice to see, I understand that, but it's not the end of the world yet. And I think if it is the end of the world, if coronavirus takes us all, then your money's going to be worthless anyway. So there's no point trying to rush to sell. Just hold on to it, in my opinion, and see what happens, and hopefully the value will rise again. What I have done though is I was funding a 95-day notice account through Moneybox as well. But what I did yesterday was withdraw £900 from that 95-day notice account. So I should get that money now by the 26th of June, I believe it is. The only reason for that being is I'm not losing any money in investments by taking the money out of that account. And I'd rather have as much available cash as possible. So what I would consider doing at the moment, if you've got investments, is leave your investments alone if you're going to get penalised for withdrawing the money, but try and get your hands on as much cash that you can easily get as possible. Does that make sense? I hope it does, because that's what I've done. And I don't want to make any mistakes either. So, according to Moneybox, I'm just going to read through their little advice screens that they put up. What coronavirus means for your investments. As you may be aware, we are currently seeing significant volatility in the global markets. If you'd like to understand more, tap through our latest article, blah, 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 blah. In the last few weeks, global markets have been rattled by the impact of COVID-19. While big moves in the stock market are often headline news and can be uncomfortable for investors, it's important to consider these against the longer-term historical context. Here we break down the possible effects of the coronavirus on the stock market and what it may mean for your investments. What's happened? When the coronavirus became known in China in late January, it was not anticipated to have a serious effect on the global economy. Fast forward a few weeks and things have changed dramatically. Due to the emergence and acceleration of the virus outside China, it has caused markets to respond as the realization set in that the outbreak would trigger at least a short-term disruption to global economic activity. Fear has also been heightened by the latest travel restrictions and cities in lockdown. Financial markets don't like uncertainty, and with many questions surrounding the virus remaining unanswered, global markets continue to try to price in the longer-term risks. As the funds on the Moneybox platform track global indices, our investors will have seen an impact similar to the performance of global markets. What should you know about market volatility? The impact of the coronavirus on the stock market has been felt heavily within the past week, with Monday, March 9 seeing the S&P 500 open at its third worst day, down over 7% from Friday's trade in history. Whilst they feel bad at the time, corrections and crashes have happened throughout history and have many triggers. 1987's Black Monday, .com crash and the global financial crisis. What you need to know about corrections. They're a 10 to 20% fall in the stock market. They happen on average every year or two. The average fall is 13.7% and lasts for 4 months on average. Recoveries, back to the levels before the correction, have taken 4 months on average. So, if this is the same as a standard correction, what's going to happen is hopefully in 4 months' time, everything's going to come back to how it was before the coronavirus affected the markets in the first place. What you need to know about a crash. They're a stock market fall of more than 20%. They happen on average once every 4 years. The average fall is 32.5% and lasts for 14.5 months on average. Recoveries, back to the levels before the crash, have taken 2 years on average. There have been 26 market corrections since World War II, as of February 27, 2020. However, the average return in the 12 months following these losses was more than 16%. Don't forget, 80% of corrections so far have not turned into crashes, and while past performance is not a reliable guide to future performance, so far 100% of crashes have been followed by a recovery that more than recovers the fall. So, as Dave Ramsey said, the only people who get hurt on a roller coaster are the ones that jump off. Now we're in a very big dip, we understand that, but advice would tell you to hold on to what you've got invested because it will likely come back up. What you should do about it. While it's tempting to take action in a downturn, often the smartest decision you can make is to continue as you were. In fact, if you contribute regularly, you benefit from the average price of the investments you buy over time. This is known as pound cost averaging. When you continue to contribute during a downturn, you buy shares at lower prices, which could be beneficial in the long term. We know that riding the ups and downs of the market can be uncomfortable, but remember the investing principle of Warren Buffett, the world's most successful investor. It's time in the market, not timing the market, that is key to success. What next? Over the last 20 years, the FTSE All-World GBP has averaged an annual return of 7.5%, and this includes the crash of 2008. So, tune out to the short-term market fluctuations and noise of the headlines as much as you can. Know your time horizon and focus on your long-term investing goals. So basically, the advice they're giving there is what I said previously. Just because it looks bad at the moment doesn't mean it's going to stay bad forever. Hopefully, it's not the end of the world. Understand that it could take a little while for things to come back to normal, but once they are back, as long as you didn't sell at the down point, hopefully you won't have lost anything. That's what I'm hoping for myself. That's what I'm hoping for everybody else. But to go back to my first point in this video, please, money isn't everything. Health, well-being, family, the safety of you and your loved ones are what is important. So just take care. Don't take any unnecessary risks. The whole world needs to sort of get a handle on this thing at the moment. Once we have, we can probably continue our normal daily routines. I have been Ollie Rosser. Thank you for watching. If you did get something out of this, please consider liking this video, sharing it with somebody who also might like to see this or hear some of the information that I've given, and subscribe to the channel. Again, it's growing slowly but surely, and I'm really pleased with it. I'm nearing that 1,000 subscriber mark, and I'll be very pleased when I get there. Have a good weekend.